organized on a pretty short notice. This is a joint webinar with RiXtrema. We serve a lot of advisors. Some of you may be our clients, I'm sure. And we have a product called Annuity Optimizer, which we're not going to focus on today because that's a separate discussion. What we want to show you today is a platform that's run by Matt Meyer and Michael Robinson, BluePrint Insurance Services, that actually creates an amazing service for our IAs. We were so compelled and we decided to share how exactly they help our IAs, and also they use our product Annuity Optimizer to demonstrate why, for example, certain fixed indexed annuities are better in a portfolio. It's kind of a demonstration tool that toward the end I'm going to be able to show it to you. Again, I'm Daniel Sachkov, the president of RiXtrema. Let me introduce Matt Meyer, who's going to speak about the platform first. Matt has been in the financial services industry for over 20 years, and he works a great deal with both high net worth families and CRIAs, CPAs, estate planning attorneys. Basically, their expertise is insurance and annuities. And as RIAs, you are very well versed in the investment world, but they can actually provide a legal and investment framework for you to easily offer those products in your practice. And Matt will talk about that. Matt, please take it away.
Thank you, Daniel, and appreciate you having us on today. As Daniel mentioned, I am the co-founder of the BluePrint, and part of our process is to help educate our partners, primarily RIAs and comprehensive advisors, position certain client solutions. And a lot of the presentations that we do focus on direct feedback that advisors are experiencing day to day. So we constructed this particular presentation with that in mind to help address some of the concerns that everyone may be dealing with in today's environment. Just with a little background, however, we're an agency, again, that focuses on helping understand your business and how we can integrate seamlessly into it. There's a variety of different client solutions that we use. We're going to focus today on just a concept that we have found that has been integrating well into businesses now. So we'll get into this. We're not going to talk about products, very specifically, but we're going to focus on more of how we're positioning and working with this. So I just want to let everyone know this isn't a product presentation. So with that in mind, I'm excited to present, and we're going to start with fixed index annuities and how they can make a difference in client portfolios. We have a lot of probably people on this call that are familiar with fixed index annuities, and some that are new to the concept and may even feel uncomfortable with the word. So I'm going to focus on trying to deliver and provide some background on the structure just in general. As I mentioned before, we're not going to talk about caps, participation rates, or spreads. My goal is to help frame this story that we believe makes sense for you and your clients. But let me be the first to say that we do not believe that a fixed index annuity is a silver bullet, but rather, when used appropriately, can be a complementary strategy that can help address market risk, mitigate behavioral risk, and may outperform bonds over time. Before I get into that, I'm going to provide a little bit of background on what we mean by understanding risk in today's environment, which I'm sure everyone on this call is well aware of, and also how we can help manage that risk going forward. And then lastly, there have been significant changes in the insurance industry that not only from a product construction, but also from utilization of technology and how we're integrating better to the RIA platforms. So first of all, let's discuss understanding risk. And we've framed this presentation kind of to address three main risks that we believe that most advisors are juggling day to day, and a lot of the feedback that we hear directly from their clients as well. So I don't know if you're like all these other advisors that we're talking to, but one common theme that I hear is when the stock market is volatile, that they get a lot of calls from their clients asking how they may de-risk their portfolios, but maybe not in those exact terms. We know, though, that it certainly will have calls that are coming in and addressing some of these risks. So one of the behavioral risk is another risk that we address, and we know this risk exists whether it's supported or not. I know that I probably have those same emotions from time to time, but it's certainly from a client perspective, we know as markets get volatile, there is an experience of behavioral risk. The last risk that we're hearing about is interest rate risk. And obviously in a low interest rate environment and the probability that the Fed will continue to raise interest rates certainly has clients calling advisors, probably talking to you guys about how to help mitigate that risk. So when we talk to successful advisors, these are kind of the common themes and frustrations that everyone is sharing right now: stock market risk, behavior risk, and interest rate risk. And this leads us to what we believe is the modern day dilemma. On one side, we have clients that may want to flee stocks to fixed income. And if you believe that their risk of interest rates rising exists, we know it isn't risk-free to flee from stocks to fixed income. And we also know advisors experience the other side of the dilemma, that they have large positions in bond funds and other fixed income, and they're passionate about their belief in interest rate hikes and potentially know that that's a position that they may lead to losses. So what do we really do? Flee to equities? I don't think that that's probably a viable solution, to de-risk a portfolio necessarily in this type of environment, especially where the stock market is. So in essence, what we're seeing is a rising interest rate environment that can negatively affect bond performance, and a volatile, potential 9-year bull market that has some investors, experiencing behavioral risk. So what do we do in this type of environment? And by the way, this is the part of the presentation where you'll potentially hear every person say that the fixed index annuity is the proper solution. But, as I promised earlier in the presentation, we don't share that belief. We do believe that when used appropriately as an overall asset allocation, the FIA can make a positive impact and address these risks that we have discussed. So let's talk about de-risking the portfolio and how the FIA can add value. For the purpose of this presentation, we're going to focus on analyzing a traditional 60-40 portfolio versus a 60-20-20, with cutting the fixed income bucket to 20% allocation and the remaining 20% into a fixed index annuity exposure. In order to frame this discussion, I'm going to refer to a detailed white paper by Roger Ibbotson. Roger is a retired professor from Yale University, and he's the chairman of Zebra Capital Management, but he's not necessarily someone who's in the insurance industry. This particular white paper analyzes a variety of traditional portfolio constructions compared to adding alternatives utilizing the fixed index annuity. So as I mentioned before, we're not going to get granular in the product design, but generally the numbers and the concepts and how these adding these type of solutions make an impact, especially in this rising interest rate environments. So our focus is going to be primarily on the fixed income bucket, not on the equity bucket. So our examples that we pulled from this particular white paper are going to illustrate that. So as a general frame of reference, this is dynamically how the fixed index annuity measured up. And the purpose of this is just for those that are not completely familiar with the new structure of fixed index annuities. This is back-tested data with certain participation rates or caps. And dynamically, this is how the FIA looked over a period of time from 1927 to 2016. So if you just look at the top line, the large cap stocks are 9.92%, long-term government bonds at 5.32%, and the fixed index annuity at 5.81%. And for those that, again, aren't familiar with it, the fixed index annuity, and we'll talk a little bit more about this, has a 0% kind of downside. So when we construct some of these diagrams, I'm going to refer to that, but this helps just frame the discussion and some of the slides going forward. So let's look at this first slide. And let me explain, the rest of the slides are very similar to this one. So we're going to focus on the top of this page. The red highlights the interest rate change. So when we're looking at each of the next few slides, they're all going to make these same assumptions. Roger Ibbotson essentially analyzed a minus 10%, a 0%, a plus 10%, and a plus 20% equity market scenario over a 3-year period. So he looked essentially at 3 possible scenarios for your clients. The market will either go down, it will stay flat, or will go up over the next 3 years. So if rates stay the same, what was the impact on a 60-40 versus 60-20-20? And again, the red at the very top, scenario 1, shows that this is a 3-year environment where rates are unchanged over that period. So analyzing the inclusion of a fixed index annuity into the portfolio in a unchanged interest rate environment. So if we look at this particular slides, we see in this first scenario that a no change in interest rate, we'll see a negative or flat market will have no positive effect. So when we look at this, we're essentially comparing it to what's going to happen in the fixed income bucket. And in this particular scenario, the fixed income bucket is returning 1.8% across the board because we have no interest rate changes. However, in the downside equity markets, now the hedge on the fixed income bucket is better because the interest rates are consistent, and that would not have a positive impact. But if we go to the next slide, and again, this is just a real quick summary. So rates are unchanged. So down market, no positive effect because you replace the fixed income, which would have had a positive return, with the fixed index annuity, which returns 0. So we swapped out the positive fixed income for 0. The up market, we did have a positive effect because we replaced fixed income with a higher performing fixed index annuity because the returns are based on the stock market. It will be more illustrative when we start to look at the rising interest rate environment, which we believe that we're in. So in this particular slide, if you recall, that rates are increasing now 1% over a 3-year period. So we have a 1% increase in rates over this same 3-year period. Now we're starting to see a minor positive impact when the equity markets are flat or down. So if we look at the 0 or minus 10, we're seeing a slight positive impact by incorporating this. However, in this rising interest rate environment, with the increase or the equity markets returning to positive, we're starting to see a more positive increase in the returns because now we've exchanged the negative fixed income bucket in a rising interest rate environment with a fixed index annuity that has exposure to the equity markets. So just to summarize that again, and I know this is very simplistic, but it's kind of the cornerstone of how we're viewing adding these into the portfolio. So an increase in 1% over a 3-year period has a minor positive impact because we've replaced the fixed income bucket, which would have had a negative return, with a fixed index annuity, which had a 0% return. And in the up market, we clearly participated in the exposure to the equity markets, and we replaced a negative fixed income bucket in a rising interest rate environment with a positive exposure to the equity markets. So now, just to kind of illustrate the last scenario here, which obviously is on the extreme, but a 3% increase over the same period of time, interest rate increase over the same period of time, we're starting to see a significant positive effect. So when we look at the down markets, we can see that the returns are almost 100 basis points better in a down market scenario. And again, we're only looking at replacing or diversifying our fixed income bucket. The same scenario in a flat market, because we're, again, swapping out a fixed income bucket that is having more negative effect due to the rising interest rate environment. And then obviously in a rising scenario in the equity markets, we're starting to see even a greater impact on the portfolio. So these are kind of both extremes in a flat interest rate environment. I don't know, what everyone's position is on where interest rates are going, but I'm sure that we believe that they're going to creep up over a period of time. However, when we look at this portfolio construction, we know that just swapping these out has an impact on the portfolio. There have not been a lot of studies that have shown the type of characteristics that Roger Ibbotson did in this particular white paper, but we're seeing, some of these numbers from a construction perspective work. So in summary, when the interest rates are rising in this particular last slide, a 3% increase, the higher rate rise will have a greater positive effect because we replaced the fixed income bucket, which would have had a negative return, with an FIA which returns 0. Again, a simple concept, however, something that can be powerful in the construction of portfolios by de-risking it. The up market, we're experiencing in a positive market exposure to the equities and outperforming what we would see in a rising interest rate in the fixed income bucket. So again, the concept is easy, the construction is easy, but the message is powerful. So the bottom line, in the rising interest rate environment, again, the market, the FIA performed at 0, which is better than a negative return for the fixed income it replaced. And in a rising interest rate scenario, the FIA had a positive return, which is better than the negative return for the fixed income bucket it replaced. So for those that are maybe familiar or not familiar, we're not going to get in, as I mentioned before, we're not going to get into the granular information about a fixed index annuity. But the basic construction of it is that we have downside protection, 0%. I know that there are fees and certain things that can be in this, but in these particular scenarios, we have 100% principal protection with downside of 0. When Roger Ibbotson, in his white paper, he ran these against scenarios that were participating in the S&P 500. The client solutions across the board have a lot of different investment options. However, we traditionally look at these as returns of 4 to 8% on the high end. However, obviously there's more complexity to a lot of these, but for the process, just to help understand in the concept, this is kind of what we're working with, a 0% with participation and upside of a selected market. So why may it work for you? Going back to some of the first slides, it may address some of the issues that we see with stock market risk in a bull market. Whether we continue to believe that it will go on for 5 or plus more years or not, we know that we'll consistently have to address it. Number two, really looking at the interest rate risk. What type of interest rate environment are we in, and where are we going to reposition assets going forward? Is it going to be in the fixed income bucket? Are there other alternative strategies out there? So we're going to know that it may be a risk that you're addressing. And then obviously your client's behavioral risk, whether it's founded in anything that's going on in the markets or not, we know that traditionally we are going to have to deal with behavioral risk. So I don't think that this is a silver bullet or a fit for everyone. I think the concept is simple. If we believe that interest rates are going to rise and put pressure on fixed income portfolios, so we're challenging you guys and particularly the construction of this is to think differently and to question maybe some of the things that we've done, even if there is a potential negative perception about annuities. We know that the way that we talk about them and the way that we position them can work inside of the portfolios, and now we have the data to support that. But they are client solutions that need to be managed. They need to have the appropriate due diligence, especially in this type of environment, to really identify where they fit. So, just to emphasize it again, I do not believe that it's a fit for everyone. I don't think that it works across the board, but I certainly think in this type of environment, we can have a positive impact for you and your clients. So a couple things that I'm going to address real quick. Integration into your business. It's one of the things that we focus on at the BluePrint is speaking differently and speaking your language, and how do we work with you in your business and not just a typical insurance provider or partner. So a lot of what we've done is try to have partnerships with insurance companies and other strategic partners like RiXtrema that can add value to the things that we're doing every day, and that we can help make doing business easier and more seamless for you. So one of the positives that we've seen in our marketplace is that there is a significant opportunity that the insurance companies have identified to continue this narrative and to help work in your business. But we've talked to them and let them know that we have to make sure that we're working in the way that fits specifically within the business and not just kind of your traditional insurance provider, as I mentioned before. So we have tools that help, especially when we were dealing with the Department of Labor fiduciary responsibilities, we have tools that can help identify the right client solutions. Canix is a tool that helps us break down every fixed index annuity and other annuities that are available in the marketplace. So when you work with us, it's certainly probably overused word, but it's a very consultative approach. We're not focused on trying to sell a product. We're focused on positioning and identifying the right solutions and using the tools that we have. The other kind of evolution of the business is that we have products now, or client solutions now, that are fee only versus just commission. So when we work with this, and again, we partner with RiXtrema to utilize their annuity optimizer, which helps us kind of come up with this story and how this, again, kind of a deeper dive into the portfolio, not with the commissions or the fee only, we can start to extract really how these type of client solutions fit into the overall portfolio allocations and the performance of the portfolio. So the insurance companies continue to evolve the products for not only fee only, but also obviously commissionable products. In addition, with the specifically on the fee only side, there is a push to help integrate the products more into your back office system. So I'm gonna just show you that real briefly, but one insurance company in particular has integrated their data feeds on the fixed index annuity side into many providers that you're probably familiar with. I know the slide's a little bit small, but they have direct feeds and then feeds through others. But the real key to this is, now we're taking a client solution that you can add to your portfolio or your management and charge an asset management fee. So there's no commissions, which enhances the product performance, and now you can get the direct feeds. So especially on the fixed side, this is a big step. It's the right step, and we're happy to have been involved in this and to help them really understand why these are important attributes to integrating into your business, which we obviously want to do. So we believe that there are going to be more insurance companies and providers that are going to continue to do this, and there are going to be different client solutions as well. If we're removing commissions, we're going to probably see solutions that don't have surrender charges, if you're familiar with those. So again, the insurance companies are slow, but they're evolving to a point that they understand that the narrative needs to change, not only for you, but also for your clients. So I want to thank everybody. I know, I wanted to keep this to 30 minutes. Part of, our goal is to continue a conversation, and, we'd like to engage with anybody that has questions, regarding this. I know it was maybe a lot of information. We've got, the entire kind of product portfolio discussions and maybe more granular into the products that we can understand. But, our objectives are, help with these concepts, to go deeper with you and understand your business, and then figure out if these type of client solutions work. And, our goal is just to engage with you differently than a traditional insurance provider. So with that said,
Matt, there are some questions. This is Daniel.
Yeah.
You probably don't see them, but there are a couple I see. One is that you mentioned that this is not a solution for everyone. Can you be a little bit more specific? Where are the instances where it is appropriate in generic terms?
So I think, from a very cursory level, that age is important. If you have somebody that's younger, I think we can, maybe have a little bit more runway to do this, where it might be more effective than a annuity, because, as you may know, annuities, when you're putting the money in, it's a long-term strategy if you're under 59 and a half, because you still have a 10% penalty tax on any withdrawals. So in your kind of typical construction of this, I would say it's going to fit, more on the kind of 50 plus age, I would believe, 45, 50 plus age. So that's one of the constraints. And then typically, I think just when we look at, constructing these, is it purely fixed income? Is there guaranteed income? Are there other particular strategies? I think it just has to be customized as opposed to a kind of broad push to, integrate it into portfolios. But age is certainly one of those.
Okay. Another question. You mentioned no surrender charges. I mean, the conditions for that, what are those? I mean, my understanding is that would be the fee only, right? Type insurance.
Yeah. And again, this is more on kind of the progressive front. There is a significant push right now on the fee only, because if you think about a surrender charge typically is locking in that client. And there are reasons that the insurance company does that, because they're hedging, they're buying options on the particular indexes. However, if we're removing the commission element, it kind of changes that dynamic. And we have heard that there may be one or two products that are going to be rolled out later this year that are going to address that concern. So it's not something that we currently have, but I did want to let you know that this is kind of the evolution discussion regarding how the insurance companies are working.
If there's no commission, how do you get paid? There's one question.
Yeah, so the no commission. Now again, remember there are commissionable products. The fee only product is designed to have those fees that we showed with regard to the Great American solution feed directly into your asset management systems. And then you would charge what you would normally charge for your asset management fees. So if you're charging for fixed income, your equities at 1%, this is just going to be the same exact thing. You're going to get the fees, you're going to charge your 1%. Now, They do have the ability to take the fees out of the annuity, but we recommend that you charge your fees as you would normally charge your fees out of the money market accounts or traditionally how you do it.
Okay, can you describe in more detail your arrangement with RIAs? Like, what's the platform? What is the how can they create a holistic platform? Obviously beyond just the fixed indexed annuities, and what does the arrangement look like?
Yeah. So what we do, our objective, and I know that I mentioned this a couple times, but our first kind of process is to understand your business, and our relationships are really kind of established as true partnerships. So when we can understand your business, we can provide and be your total insurance solution. And that would, really incorporate life insurance, long-term care, disability insurance, and annuity business. And what we believe is that incorporating these type of client solutions and utilizing our expertise and our access and working with the insurance companies can immediately provide that kind of holistic approach for you. Essentially, we become your partner that provides the education, the access, the due diligence, the integration into your business from an insurance perspective. And we have experience in a lot of different fields, from estate planning to business planning. But the primary kind of objective, and I know I continue to mention this, is everybody's practice is a little bit different. Everybody's clients are a little bit different. And if we can help work on the top down as opposed to the bottom up, where you say, hey, I just need a product, I need to, have access, and I need some term quotes. We would rather have that discussion. We've got a client, and this is what we're doing for this client. Do we see that a long-term care event might disrupt that particular retirement plan that we've put together? And if it would, how do we hedge against that? So a long answer to that question is, we want to go deep, we want to be partners, and you've got the ability to start operating in an insurance capacity, immediately upon, working with us.
Okay. I think that, let me see what the other questions. Well, those already questions. I mean, can you clarify? There's a question about, how exactly do you get paid? I guess I'm not sure if that was answered. I mean, I think it was, but.
No, I don't think we addressed that. So the typical distribution with an insurance provider is that there's an advisor or agent. They typically say agent. We say advisor. The advisor gets paid from the insurance company directly. And for our marketing, constructing, working with the insurance companies, they pay us an override. So if it's an annuity product or a life insurance product, we're working on an override, but the advisor is still getting paid. Now, we do, for those that, we do have a couple different ways that we can integrate with you. If you're an insurance expert and you want to continue to enhance that and you want to work with us, that would be a typical construction. We're working on the override. If there was an opportunity or you needed additional support from a point of sale or getting on the phone with clients, walking through that, completing applications, we might suggest a change to that relationship to some degree, where we're acting a little bit more as an advisor. But our typical kind of our typical how we're plugging in is we're providing education, access, illustrations, work, all of this stuff, and we're working on an override.
Okay, that makes sense. I think these are most of the questions. I actually will show real quick how the fixed index annuity looks in the annuity optimizer as well. I think that's going to reinforce some what you were discussing.
Absolutely, and I just briefly hit on that, but I think it's a really powerful tool, and how it tells our whole story as well.
Absolutely. So for those that see the screen, oops, that's a different screen, sorry. Right there, so we have a very simple comparison. This is a tool called Annuity Optimizer. Matt and the BluePrint use it. So we have a number of RIAs who use it. If you work with Matt, obviously they run all the reports for you, but you can get it direct. Though I think that if you work with them, it's like all part of the holistic solution that they provide you. What I have here on the left is a portfolio. It's kind of a mutual fund portfolio, nothing spectacular, just a sample name, Jim Palmer. That portfolio has these funds in it: Putnam Europe Equity, SPY, GHHCX, and the Western Asset Corporate Fund. So it's a somewhat balanced portfolio. And on the right, I have a fixed indexed annuity. So I'm not an expert in these instruments, but this is one of the real instruments that is out there. I don't know if it's exactly available right now, but I'm pretty sure that I've seen even a better instrument than this. That's the Great American. And so here are some settings of the annuity here on the right. I'm not going to go in depth to all of them, but I mean, important is the cap, right? That's when you buy fixed index annuity, what happens is insurance companies, they create a strategy. They basically maximize the return, and they try to reduce the risk by buying options. And therefore, they have a cap on the return. So your underlying index is S&P 500 in this case. So this fixed indexed annuity is based on that index. If you click, you see there are lots of other indices that fixed indexed annuities are based on. There's a minimum rate, so the return doesn't go below that rate. That's the beauty of fixed indexed annuity. And that's how essentially they make money. There's no explicit fee. The money is made through that spread. There's a spread of 1% too. So whatever the return is, 1% goes to the insurance company. And I've seen a product like that with no spread also. But I want to be conservative and not overstate the case. And importantly, so on the left we have that mutual fund portfolio. On the right is the annuity. What I'm doing is I'm showing a sample of what if we took 40% of the portfolio and put it into the annuity. When would the portfolio win, and when annuity would win in this case? Now, remember, there's no such product out there that wins in all environments. I mean, it just doesn't happen, right? Just like we don't have a software called Tomorrow's Prices. It just doesn't exist. It's always depending on situation. So let's look where one is better than the other. And what we're going to look at, you see there are two lines here on the graph. The red line is the mutual fund portfolio, and the blue line is the mutual fund plus 40% of that annuity. And so you can look at the graph and you can see the terminal value of the portfolio projected out to the age of this person. In this case, we started age 60, but we probably should start a little bit. We could start sooner as well. Let's start at 55. So I changed the age to 55. We can go back here and look at the graph. The red line, again, is the original mutual fund portfolio. The blue line is the blend. You have the fixed indexed annuity. So you can see which one is doing better. You could also look at the internal rate of return. That's an important statistic. Sometimes it's hard to compare like insurance type products to mutual funds, just because when you have riders and things like that, internal rate of return is the best measure to compare it. So we're going to look at a very simple test. We're going to have a horizon of, the person's 55. Let's say it's 23 years investment horizon, and we're going to assume a return of 5%. So that's a hypothetical return. That concerns both the mutual fund portfolio and the S&P 500 index. In fact, that's even a bit generous to the portfolio because remember, it had some fixed income too. It's unlikely to behave as the same as the S&P 500 in terms of the upside, but we're going to make that assumption just to make it apples to apples. And here's what I'm going to do. I'm going to slide this return bar, and it's going to show me when mutual fund portfolio will be better. Okay, at the 5% return, we can clearly see. Oh, we also modeled two downturns. You can see there's one downturn, there's another downturn. So over 23 years, we modeled two downturns, 25% each. I mean, that is not horribly conservative. It's not like we're saying the world is ending. Okay, we're saying there are two drops by 25%. We experienced much more in the past, in the past 23 years for sure. So when the drops happen, clearly annuity doesn't go down, the annuity portfolio, because the mutual funds go down, but the annuity holds. It provides a cushion, and then in the upmarket, it grows. Okay, but at 5%. Now, what happens if the return is higher? Okay, if we make the return 6%, 7%, you see the mutual fund portfolio starts catching up. It's getting close. 3.16 IRR versus 3.77 IRR. And so. Michael or Matt just pinged me that the actual cap is much higher. So I'm not doing justice to this annuity. The cap is 7.4%. They actually increased it, so that's good. But let's be conservative. So I'm not doing justice to the annuity because I don't want to, over tilt it. Let's say this is not as good of an annuity as in reality it really is. So, but still, when we get a 7% return, mutual fund portfolio is still underperforming. Okay. Now, honestly, who believes at this stage of the market that we're going to have 23 years of 7% returns just with two downturns of 25%? Okay. I mean, some people might believe that. It's kind of hard for me to believe, maybe on a nominal basis, if the inflation really starts, which also it's not far from certain. But if you keep going, right? So at about 10% return, that's when really the mutual fund portfolio outperforms. So it's really a simulation that's pretty straightforward. We're not predicting the future. Right? That's very bad to do. I mean, nobody knows the future. Risk management is not about knowing the future. What we're doing here is we're saying, okay, what return would make the mutual fund portfolio perform better? And it's actually 10%. Now, if I put the actual cap for this annuity, which is 7%, then it's not even going to be funny. I mean, it's going to be like 15%. So if we did that after 2008, then annuities don't look good because, if you're just recovering from a big downturn, you have a kind of a floor that doesn't look good. But I think, given where we are at historically high valuations, I cannot believe that. It's hard for me to believe personally that the return will be 10% going forward. And I know of no serious analyst that does. So it's these kinds of tools that are very simple to illustrate what happens, right? What needs to happen for a high expense mutual fund portfolio to outperform a portfolio blended with an annuity, okay? And it could happen. And for years, you could have high performance and the annuity portfolio would languish. But over the long run, if you have some risk aversion, then it might be better. So that's the illustration. Again, it doesn't decide the case, and every case is different. And depending on the writers, it could be different. Depending on the annuity, too. There are lots of horrible annuities. I'm not showing you a horrible one. I'm showing you kind of probably mediocre annuity. Now, in reality, this annuity is actually a good one if I entered the right numbers. But there are also horrible ones where you'll see that it looks much, much worse. But the point is, there are tools out there to show and demonstrate how adding a fixed index annuity helps the portfolio. And that's really what I have. I think that we're done with all the questions. I hope you all found it interesting. Obviously, if you want to partner with Michael and BluePrint, we'll send you a recording, and you'll have a chance to reach out to them. You can reach out to them, reply to the recording email, and we can take it from here. If you have any questions, I'll send you a recording. I'm Daniel. You'll get an email from me with a recording. You can just reply to me and ask me whatever wasn't answered on that call. I hope you all found this useful. This was a good use of your time. I really appreciate you signing on such a pretty short notice. And have a great day, and have a great coming holiday, 4th of July coming up. Bye.
Thanks, guys.